So, so after this crash, a lot of people wanted more federal oversight in regulating the insurance industry, and here were the arguments. They wanted uniformity in state regulations. So regulations vary by state. And if you are an insurance company operating in numerous states, then it's pretty difficult to make sure that you're covering all the regulations in every state. So people were saying, hey, let's just have one body and one set of regulations, and it'll make it a lot easier for the insurance companies to operate. And it makes sense, okay? This here, I'm not even sure where that comes in. Okay. And if you have one regulatory body instead of 51, then you can identify systemic risk easier. So I understand that, and I understand this. You know, I'm not sure if they're saying here that if you have one agency that represents the United States of America, I think maybe that's what they're saying, when you go in to negotiate with a foreign country, we're negotiating with England to come up with an insurance agreement, do you want to have the state of Arkansas negotiating with the government of England? Or do you want to have an agency of the United States government negotiating with England? So it's power. It's power. Okay. So I already said this one here, working with one body. Whoops. So these were arguments that were made that support having federal regulation over all areas of the insurance industry and doing away with the state bodies. All right. So on the other side of this argument, why should we maintain state regulation? Because when you're closer to the customer, you can respond more quickly. Right? That's true. All right. If you have federal regulation in addition to state regulation, you've got a dual system, and it's more complicated. But I think the easy thing to say here is, yeah, you don't have any of this?
We haven't had, or I haven't had the last 3 slides, I think. The next section for me was methods of regulating insurers.
Okay.
They're farther down in the...
They're down
So the
below.
order has changed?
Okay.
Okay, I'll have to look at it.
Okay.
I'll have to look at it. All right. I think this is kind of dumb. The easy answer to this is we're going to either have federal regulation or state regulation, and not both. You can easily solve that. Okay. All right. Another counter argument, and I use this argument myself in a different way. How many things does the government do well? Not many, honestly. And yet we're asking the federal government, we're going to turn over more and more of our lives to the federal government. Okay? Doesn't make a lot of sense. Okay? All right. To address the issue of the uniformity of state laws, there is an organization called the National Association of Insurance Commissions. And they have created a set of standard laws, and they have submitted those to every state commission for the purpose of trying to minimize the differences in laws and regulations on a state-by-state basis. Now they're not, you don't have to adopt them, but most states do. So they're saying, hey, we can counter this argument here by having this. We don't need one federal regulator to have uniform laws. All right. Now, anybody ever taken a political science course? One of the things you learn in political science about having state government is that having a state government is a good place to experiment with a policy. So we're thinking about having socialized medicine. Let's try it on the state level first and see how it works. If it works well, and we learn a lot about what works and what doesn't work, once we learn that, then we roll it out nationwide. Okay, that's an important concept. They're laboratories. States are laboratories. Okay.
You really did listen to those hearings, didn't you?
Oh, I learned that in freshman political science.
Oh, yeah.
But did they mention that in the hearings?
Like a quote.
Okay. That's, I mean, within the first month of my first political science course, we learned that. I was like, yeah, that makes sense. I didn't know they said it. I didn't hear that.
They were talking about like the state constitution versus federal.
Right. Yeah. So try it on a small scale and think about it in business. You're going to do that. Okay? Before you roll out a national effort, you try it at 1 or 2 or 3 or 4 stores. If it works well and you learn what works and what doesn't work, then you roll it out nationwide. Same concept, okay? And they're saying that we're just closer to the situation. We can respond more quickly, and we have a better understanding of what's going on than those guys in Washington, D.C., okay? And these arguments apply to a lot of different areas of business. So, for example, in banking, you have a community bank, and one of the arguments for having a community bank is the bankers know who you are. They know your business. They know the area. They know the market. They know your customers. And when a regional or a national bank buys the community bank, then you no longer have a loan that's done based on a handshake. It's based on the paperwork now. And sometimes that's a good thing, but often it's not a good thing. It's not a good thing, okay? Because Regions Bank is a good example. You want to get a loan done, they ship it off to Birmingham, and they don't know Homer's Ace Hardware here, okay? They don't care. Either the paperwork is good or it's not. All right. So shortcomings of state regulation, this has been pointed out, that they haven't done a good job of protecting customers. They don't handle complaints as well as they should. Well, if they're not handling complaints well at the state level, imagine how they would handle them at the federal level. Okay? If you call the Social Security Administration to try to get information about Social Security, they'll tell you in the message that you're going to be on hold for 45 minutes or more to talk to somebody. I've tried. I've done it several times. All right. And I'll tell you this, I've tried to get information from various state agencies. Ooh-wee. You call somebody and they say, well, that's not my department. I'm going to transfer you. And they transfer you over here. And they say, well, I don't handle that activity. And they transfer you over here. And you might talk to 5 people before you finally find somebody who understands what you're talking about. It's really tough, really tough. Okay, so they don't do a great job of examining these companies. And market conduct talks specifically about trade practices, sales practices, claims practices. Okay. The state insurance commissions, there are 3 big issues when it comes to insurance, and we've heard them. There's been so much talk about the Affordable Care Act in these hearings that they highlight important issues about insurance. So really, availability is one issue. And really, availability and access are very similar. And the question is insurance there? Can you get insurance? And then the second, a closely related topic is affordability. Okay, so insurance is available to you, but is it affordable to you? Those are two issues. And the federal government does a much better job because they're in DC and they're looking at across the country. And they do a much better job of looking at these accessibility and affordability issues rather than the states. Okay? All right, conflicts of interest. This is a biggie, and it's a biggie with all regulations. And again, political science. Okay? And I read about this in political science classes, and I saw it firsthand because I worked for the State Commerce and Industry Committee. I worked for a state House member who was head of the committee in South Carolina for a year, and I saw this, and then I worked for the State Chamber of Commerce, and I saw this. One of the conflicts is that you want someone who understands an industry running the regulatory body, which means you hire somebody from the industry, and you do that for their knowledge. Unfortunately, those people also know the other players in the industry, and that creates a conflict of interest. It's called captive regulation. Okay? So this is an issue with every type of regulation. Okay? And so what happens often, and now there are rules against it, it's not enough, is let's say you spend 8 years, which is 4 terms in the House of Representatives, and then you either retire or you're not reelected, you then go into business as a lobbyist. And who do you call on? You call on your former colleagues in the House. Why does somebody hire you? Because you know all those people. Okay? So those are conflicts of interest. Okay? I mean, and that's what happens all the time. How do you think legislators and presidents who had no net worth at all going into office, you know, within 5 years after they get out of office, they're multi-millionaires? Okay? That's how. All right. So, here you go. No, we're caught up. How are insurance companies regulated? Okay, and it starts with legislation. Okay, so state legislatures and federal and Congress passes laws. What is it focused on? Well, charters, formation, and licensing, which is for salespeople, giving people the authority to sell. Okay. Financial requirements, okay? Making sure that companies are strong financially. Rates. Sales and claims and claim practices. So these are the areas that legislators or legislation and regulators really focus on. Approve new companies. Make sure salespeople are educated. Make sure the companies have adequate capital and that they make safe investments. Make sure that rates achieve their goals. Make sure that companies are not cheating on sales and claims. Okay? How these companies are going to be taxed. What to do if a company runs into trouble financially. Okay? These are all areas that legislation focuses on. After legislation, there are court decisions. Court decisions. Okay? And they focus on things like looking at policy provisions and making sure they're legal. Okay? Then you have state insurance departments, and they're all involved with the NAIC, very powerful group. Oops. Let's see what we have here. All right, everybody caught up? Okay. All right, so let's look at formation and licensing. So to form, you have to have minimal capital, a minimum amount, not minimal, but a minimum amount of adequate capital. 3 types of companies, and yes, you're going to see questions about this. A domestic insurance company has a headquarters in the state. Domestic. Foreign, sounds kind of funny, but they're from Alabama. So an insurance company that doesn't have a headquarters in your state, they have a headquarters in another state, but they're doing business in your state. Okay. And then lastly, alien. Okay, where this is where Lloyd's of London comes in. Okay, so it's an insurance company that is chartered in a foreign country, and they are operating in the state. And usually it's a very specialized product. And Lloyd's of London has a lot of very specialized products. Again, they're the ones that, I play golf, and so I go to some golf tournaments, I play in some golf tournaments, and a lot of times there are cars that are given away for hole-in-one. And you can't find an insurance provider in the state of Arkansas that's going to write a policy to cover that. But Lloyd's does it all the time. So you give Lloyd's a couple $100, and they say, if somebody gets a hole-in-one, then we'll pay we'll pay the cost of the car. It's a risk. All right. Okay, so let's look at some of the solvency regulations. It starts by requiring companies to disclose financial information. Okay? And the way they disclose financial information is dictated by law. Statutory means law, statute. A statute is a law. Okay? So the law is different from GAAP. So when you disclose on a report, and that's called a regulatory filing, and you must use the definitions of the state laws to come up with the amounts that you're putting on your report. Okay? So obviously this means you have to have a positive surplus, and surplus is owner's equity. All right. Admitted assets are assets that an insurance company can claim on their balance sheet. They're called admitted. They're allowed. Okay? And then the states tell you how much reserves to have in each area that we went over in the previous chapter, and how you calculate those reserves. Okay? So that everybody's on the same page, everybody's doing the same calculations, so that you can compare the different companies and know what you're getting. Okay? And the surplus is closely monitored along with the reserves to keep the companies out of trouble financially. All right? Okay. So, life and health insurance companies have to meet additional capital requirements, surplus requirements, bless you, because the claims are so long-term in nature. The situations are so long-term in nature. Okay. And so there is an added type of standards that regulators look at called risk-based capital. And if you've had commercial banking, we saw this in commercial banking as well. Okay? So risk-based capital is this idea that you have to hold a certain amount of capital based on the riskiness of your investments and the riskiness of your insurance operations. So the more risk you have, the more capital you're required to hold on your balance sheet in case the stuff blows up. And let me tell you that while these things are eminently fair, okay, the insurance companies and the banking companies fight tooth and nail over these things with the federal government because they want to maintain the minimal amount of capital possible. They want to put all their capital to work, and some of them want to take as much risk as they can possibly take because that's where the returns come from. Okay? So it is a battle that is fought every day between the industry, whether it's insurance companies or banks or investment banks. They're fighting with the regulators all the time. Okay? I've seen it. Okay? So your risk-based capital, how much you have to set aside, is based on your investments, okay, and how much risk you're taking in terms of your underwriting. What happens if interest rates go up or down? Okay. And what is your product mix? What kind of products are you selling? And how much of your business do they represent? Okay. All right. So, how much capital you maintain, how much reserve you have compared to your capital will determine if the regulators will mandate that you have to make changes at your company. Okay? So again, you've got a whole team. You're an insurance company, you're a bank, you're an investment bank, you have a whole team of attorneys. Full-time. All they do is fill out forms and talk with other managers in the company about the regulations to make sure that the companies are in compliance. You got a whole team of people. It costs you well over $1 million a year in expenses to run a compliance department. It's a big operation. And one of my former students, he was an accounting major, and he went to work for PwC, and he did audits. They audited several banks, and he did that for 4 or 5 years, and then he went to work for the State Banking Commission. He's not an attorney, he's an accountant, but he had a background